Right now, there's a narrative taking over financial media, and the story goes like this. China just banned paper gold. Millions of traders are being forced into physical bullion, and the global gold price is about to skyrocket. It sounds like the ultimative catalyst, right? Except when you look past the sensational headlines and look at the actual exchange data, the reality is completely different. Let's break down what actually happened. I'm Philip, your contact in China. No drama, just data. On July 24, China's largest bank, ICBC, alongside several other major commercial banks, terminated retail agency services for leveraged paper gold trading. Now, internet commentators immediately declared paper gold is dead. China is forcing a physical squeeze. That is a massive oversimplification. Anyone claiming this was a sudden ban on paper gold is ignoring two massive facts. First, did China ban gold ownership? Not at all. Chinese citizens can still buy gold bars, trading gold ETFs, and set up long-term accumulation plans. Second, what was actually removed? Regulators only cut off retail access to specific leveraged contracts on the Shanghai Gold Exchange. In simple terms, they stopped everyday retail investors from gambling on gold prices with borrowed money. Why did regulators do this? It's basic risk management. Gold has seen extreme volatility recently. When inexperienced retail traders play with high leverage during market swings, they get wiped out. Beijing stepped in to protect commercial bank balance sheets and reduce systemic financial risk. So how much did this move actually impact the global market? Let's look at the numbers. According to the SGE's own data, the affected bank-intermediated retail trading accounted for less than 5%, just 4.88% of total gold trading volume. 5%. On top of that, Chinese banks have been quietly phasing these retail accounts out since 2020. This wasn't a surprise attack. The market had plenty of time to digest it. And the immediate impact on global gold prices when the cutoff happened? Almost non-existent. Does this mean the policy change doesn't matter? No, it doesn't matter. Just not in the way the hype channels are telling you. What's happening here is a slow, strategic transformation. Beijing is stopping everyday investors from gambling on gold prices and encouraging them to buy real gold for long-term savings. At the same time, China is making it easier to import physical gold and building massive storage vaults in Hong Kong. The long-term goal, China wants more influence over global gold prices, a price backed by actual physical gold instead of paper contracts trading in Western hubs like London or New York. At the fact that central banks everywhere are buying gold at record levels, and you have a very strong foundation supporting the market. So what is the bottom line for you as an investor? Don't buy into the panic or the promise of an overnight 10x explosion. International gold prices are still heavily driven by macroeconomic forces. US interest rates, the dollar, inflation, and global central bank reserves. Ending a minor retail leverage product in China doesn't rewrite global supply and demand overnight. What we are seeing is not a sudden price shock, but a healthy structural shift, moving away from leveraged paper speculation and toward real physical backing. What do you think? Do you believe physical demand will eventually override the paper exchanges in London and New York? Drop your thoughts in the comments below. If you want clear data-backed analysis instead of clickbait, hit the subscribe button. Thanks for watching, and I see you in the next video.